are your top market takeaways. Tariffs continue to dominate investing conversations. But has the impact of tariffs even arrived? Scanning economic data, it seems to be showing up in some places, but not all. Understanding how trade policy affects the investment landscape could take a while, maybe even years. Let's unpack what we know now. Gauges of sentiment like small business optimism, consumer perceptions, and inflation expectations have been among the first sets of economic data to respond to the tariff impact. They're reflecting fears that the economy might slow down and inflation might move higher again. Those soft data releases are valuable in informing expectations about the path forward, but they are distinct from indicators of actual economic activity. So far, there have only been a few observable impacts on this kind of hard data. For example, the spring brought a surge in car buying, probably driven by a rush to grab vehicles that were already on dealer lots before inventories got replenished with vehicles that are subject to the new tariffs. More broadly, first quarter GDP data showed an enormous surge in imports overall. The going assumption is that the near-term surge in certain spending categories could give way to a demand slowdown in the months ahead. The degree to which that happens remains to be seen. Near term, it's worth watching how businesses respond to the evolving environment. Are they passing increased cost onto their customers and pushing inflation higher as a result? Are they facing challenging decisions to cut costs, perhaps by pursuing hiring freezes or even layoffs? Uncertainty prevails, and we do expect to see tariff impacts become more pronounced in the second half of this year. Stay prepared for volatility to continue as a result. And to navigate it, make sure your allocation is matched to your goals and appropriately diversified. To learn more, please visit chase.com/theknow.